You know what's wild? The average American is sitting on over $40,000 in total debt right now, and they're paralyzed by the most expensive question in personal finance. Should I pay this off or invest instead? And here's the thing that nobody talks about. The wrong answer to this question could cost you over $800,000 by the time you're ready to retire. Yeah, you heard that right. $800,000. Hi, I'm Matt. On this channel, I help you build real wealth using actual math, not outdated advice. Hit subscribe because in the next 20 minutes, I'm showing you the exact framework to make this decision based on your situation, not some guru's opinion. Because here's what drives me crazy. Every personal finance guru out there has a strong opinion on this. Pay off all your debt immediately and never borrow a penny. Or the opposite camp. Leverage everything, invest aggressively, become a real estate mogul. But reality, it's way more nuanced than that. The decision between paying off debt and investing comes down to interest rates, risk tolerance, opportunity cost, and, this is the part everyone forgets, your own psychological relationship with money. Before we dive into the math that's going to blow your mind, let's get one thing straight. If you don't have an emergency fund, stop right here. Seriously, whether you choose to pay off debt or invest, you need a financial foundation first. I'm talking about 3 to 6 months of expenses sitting in a high-yield savings account that you can access immediately when life throws you a curveball. Here's why this matters. Imagine you aggressively pay down your mortgage, then your car dies with a $4,000 repair bill. Now, you're either pulling money out of investments at the worst possible moment or reaching for a credit card that charges 22% interest. You just undid months of progress because you skipped the foundation. The same logic applies if you invest everything and then face an emergency. You're forced to sell at a loss and pay capital gains taxes. This is why the emergency fund isn't optional. It's the bedrock of every other financial decision you're going to make. Without that cash cushion, you're one unexpected expense away from derailing your entire strategy, whether that's debt payoff or investing. So before you throw one extra dollar at your student loans or your mortgage or your index funds, make sure you've got that safety net in place. Got it? Good. Now let's talk about the decision that could literally make or break your financial future. Let's start with the case for paying off debt, because I'll be honest, there's something psychologically powerful about being completely debt-free. The feeling of owning your home outright, having zero payments to anyone, watching your entire paycheck hit your account without a chunk immediately disappearing to loan servicers, that's real freedom. And the psychological benefits aren't just touchy-feely nonsense. They translate into actual financial decisions. When you're drowning in monthly payments, mortgage, car loan, student loans, credit cards, it's nearly impossible to save and invest meaningfully. You're living paycheck to paycheck, barely scraping by, and the idea of investing feels like a luxury you can't afford. Every dollar that goes to debt payments is a dollar that's not building wealth. And here's the kicker. A huge percentage of those payments is going straight to interest. You're literally making your lender rich while staying broke yourself. The average American is hemorrhaging over $30,000 annually just in debt service, mortgage, car payment, student loans, credit cards, before buying a single grocery or paying a utility bill. No wonder people feel trapped. But here's what happens when you eliminate that debt. Suddenly, you've got breathing room. It's like getting a massive raise without changing jobs. Instead of just surviving, you can actually start building wealth. Max out your retirement accounts, invest in index funds, maybe even start that business you've been dreaming about. The psychological weight lifts and the financial possibilities explode. There's another massive advantage: risk elimination. When you pay down debt, you're earning a guaranteed return equal to the interest rate on that debt. Got a credit card charging 22% interest? Every dollar you use to pay down that balance earns you 22% return with zero risk. Show me an investment that guarantees 22% annual returns. You can't, because it doesn't exist. Even with lower interest debt, this logic holds. Paying off a 7% car loan is like earning a guaranteed 7% return. In a world where the stock market is volatile and nothing is certain, that guaranteed return starts looking pretty attractive. And let's talk about cash flow, because this is where the debt-free approach really shines. Cash flow is king, especially as you get older and closer to retirement. When you're 65 and ready to hang it up, you don't care as much about having the absolute maximum net worth. You care about how much money flows into your account every month without you having to work for it. If you're debt-free, your living expenses are dramatically lower. You can retire on less, you have more flexibility, and you're not vulnerable to market crashes right when you need your money. But here's what the wealthy know that most people miss. Being debt-free feels great, but it might not be the optimal financial strategy. And that's what we need to talk about next.
Pause for a second and ask yourself this question. Would you rather be debt-free in 15 years or financially free in 30? Because those might not be the same thing. And understanding the difference is where most people completely miss the boat on building real wealth. The case for investing instead of aggressively paying down debt comes down to one concept: opportunity cost. Every dollar you throw at your mortgage or your car loan is a dollar that's not in the market, growing, compounding, and potentially making you wealthy. And when you look at the actual numbers, the difference is staggering. Let's talk about the S&P 500 because this is the benchmark that matters. Over the long term, and we're talking decades, the S&P 500 has returned about 10% annually. That includes the Great Depression, the dot-com crash, the 2008 financial crisis, the COVID pandemic, all of it. The past 3 years alone, we've seen returns of 26% in 2023, 25% in 2024, and around 12 to 15% year-to-date in 2025. We've been on an absolute tear. Now, I know what you're thinking, but Matt, what about the bad years? Fair question. In 2022, the market was down. In 2008, it dropped 38%. In the early 2000s, we had 3 consecutive years of negative returns. The market absolutely has volatility, and anyone who tells you it's a sure thing is lying. But here's what matters. Over any 20 or 30-year period, the market has always recovered and then some. So here's the math that changes everything. Let's say you've got a mortgage at 6% interest. That's about where rates are sitting right now after the Fed's rate cuts. You've also got an extra $1,000 per month that you could either throw at that mortgage or invest in an index fund. What's the smart move? If you invest that $1,000 per month into the S&P 500 and it averages 10% returns, which is conservative based on historical data, you're not just earning 10% on your initial investment, you're earning returns on your returns. That's compound interest, and it's the most powerful force in finance. After 30 years, you're looking at nearly $2 million. Compare that to paying off your mortgage early. Yeah, you save on interest payments, and that feels good, but you're trading the certainty of eliminating a 6% debt for the potential of earning 10, 12, or even 15% returns in the market. The spread between those two numbers, that 4 to 9% difference, is where wealth is built. And here's something that blows people's minds. Inflation actually works in your favor when you have a fixed-rate mortgage. Your mortgage payment stays the same dollar amount for 30 years, but inflation is constantly eroding the value of that dollar. Right now, inflation is running around 3% annually. That means every year, your mortgage payment is effectively getting cheaper in real terms. You're paying back your loan with cheaper money while your investments grow faster than inflation. But, and this is crucial, this strategy only works if you can handle the risk.
We're about halfway through, and if you're still with me, you're already ahead of 90% of people who never do this math. Here's the number that changes everything: $826,339. That's not a random number. That's the actual difference between these two strategies over 30 years. Let me show you exactly how this plays out. Let's use a real example. You've got a $350,000 mortgage, 30-year term at 6% interest. Your monthly payment is about $1,671. You're making decent money, and you've got an extra $1,000 per month burning a hole in your pocket. Decision time: mortgage or market? Scenario 1, aggressive debt payoff. You take that extra $1,000 and throw it at your principal every single month. The result? You're completely debt-free in 14 years and 5 months instead of 30 years. You've slashed the life of your mortgage in half. Over that period, you'll pay about $110,000 in total interest, way less than the $250,000 you'd pay if you just made minimum payments for 30 years. Now, once you're mortgage-free at year 14, you take that total payment, the original $1,671 plus your extra $1,000, and you start investing the full $2,671 per month. You do this for the remaining 15 years and 7 months. Assuming 10% average returns, you end up with about $1.2 million in your investment account at the end of year 30. subtract the $110,000 you paid in interest, and your net position is roughly $1.09 million. You're mortgage-free with $1 million portfolio. But now, look at scenario 2. Same mortgage, same extra $1,000 per month. But instead of paying down the mortgage, you just make the minimum payment and invest that $1,000 from day one. You're still paying your $1,671 mortgage every month for the full 30 years, and yes, you'll end up paying $251,000 in total interest over that period, way more than scenario 1. But here's where it gets interesting. That $1,000 per month invested at 10% average returns for 30 years, it grows to about $2.17 million. Your total invested of $2.17 million minus the $251,000 in interest you paid over 30 years leaves you with a net position of about $1.92 million. The difference? $826,000 more in scenario 2. That's not a typo. By investing instead of aggressively paying down a 6% mortgage, you end up with over $800,000 more after 30 years. This is the power of the spread between your borrowing rate and your return rate. This is why wealthy people leverage low-interest debt instead of paying it off. Now, before you go refinancing your house to throw everything into index funds, let's be crystal clear about what this math assumes. It assumes the stock market averages 10% annually for 30 years. That's a reasonable assumption based on history, but it's not guaranteed. It assumes you have the discipline to actually invest that $1,000 every single month for 30 years without touching it, and it assumes you can emotionally handle watching your investment account swing wildly up and down while you're still carrying a 6-figure mortgage. What's your risk tolerance on a scale of 1 to 10? Because if you're someone who panics when the market drops 20% and sells everything, this strategy will destroy you. The math only works if you stay invested through the crashes, the corrections, the years when the market returns negative numbers and everyone's screaming about recession. If you can't handle that, and many people can't, then the guaranteed return of paying off debt starts looking a whole lot better.
Let's talk about what's actually happening in the economy right now, because this is where theory meets reality. We're living through one of the most interesting financial environments in recent history, and understanding this context is critical to making the right decision for your situation. Mortgage rates today are hovering around 6% for a 30-year fixed loan, and just over 5% for a 15-year. That's down from where we were earlier in 2025, when rates briefly touched 7%, and way down from the peak in late 2023, when rates were pushing 8%. The Federal Reserve has been cutting rates. They did a quarter-point cut in September and another in October, and there's probably another one coming before year-end. The market is pricing in rates continuing to ease into 2026. So what does this mean for you? If you locked in a mortgage at 7 or 8% over the past couple years, refinancing might make sense soon. But if you're sitting on a mortgage at 6 or below, you're in an interesting sweet spot. That interest rate is close enough to the historical inflation rate that you're basically borrowing money for nearly free in real terms. Here's why. Inflation is running at about 3% annually right now, down from the spikes we saw in 2022 and 2023, but still elevated from the Fed's 2% target. When inflation is at 3% and your mortgage is at 6%, the real cost of your debt, the inflation-adjusted rate, is only 3%. Compare that to someone who took out a mortgage in the 1980s when rates were 12%, but inflation was only 4%. Their real cost was 8%. You're actually in a better position despite the higher nominal rate. Now, let's talk about credit cards for a second, because this is where the math flips completely. The average credit card interest rate right now is somewhere between 20 and 22%. Some cards are charging 25, even 28%. At those rates, there is no scenario where investing makes more sense than paying off that debt. None. Zero. If you're carrying credit card balances, that needs to be your absolute first priority after your emergency fund. Why? Because the likelihood of you consistently earning 22% returns in the stock market is essentially zero. The S&P 500's long-term average is 10%. Sure, we've had some great years recently, 2023, 2024, even 2025 so far, but nobody expects these returns to continue forever. Paying off 22% debt is like finding a guaranteed 22% return investment, and those don't exist anywhere else. So here's the framework for making this decision. Look at your interest rates. High interest debt, anything above 8 or 10%, should be eliminated immediately. We're talking credit cards, personal loans, maybe some car loans. These are wealth destroyers, and no investment strategy can overcome their drag on your finances. Moderate interest debt, think 4 to 7%, is where the decision gets interesting. This includes most mortgages right now, some student loans, and certain auto loans. At these rates, you could make a mathematical case for investing instead of paying off the debt, especially if you're young and have decades for compound interest to work. But you need to be honest about your risk tolerance and your discipline. Low interest debt, anything below 4%, is actually desirable from a pure math standpoint. If you've got a mortgage at 3 or 3.5%, you'd be crazy to pay that off early. That money should be working harder for you in investments. Yeah, I know it feels weird to owe money when you don't have to, but this is what separates wealthy people from broke people with good credit scores. And here's something else to consider. Liquidity matters. When you pay down your mortgage, that money is locked into your house. You can't easily access it without taking out a home equity loan or selling the property. But money in an investment account, that's liquid. You can access it if you need it, whether that's for an emergency, an opportunity, or just rebalancing your portfolio. There's real value in that flexibility. Are you paying off 6% debt while missing 12% returns? That's the question you need to ask yourself, and the answer entirely depends on your personal situation.
So after all this math, all these scenarios, all the back and forth, what's the actual answer? Do this. Stop treating it like an either-or question. The optimal strategy for most people is somewhere in the middle, and it evolves as your life changes. Here's the framework I actually use and recommend. First, build that emergency fund. 3 to 6 months of expenses, non-negotiable. Second, eliminate high-interest debt immediately. If you're carrying credit card balances or personal loans above 8%, throw every extra dollar at those until they're gone. Third, contribute enough to your retirement accounts to get any employer match. That's free money, and you're leaving it on the table if you don't grab it. Now, once you've done those 3 things, here's where the decision gets personal. If your remaining debt is low interest, below 5%, and you're young with a long time horizon, lean heavily toward investing. Max out your tax-advantaged accounts, build your brokerage account, let compound interest work its magic. You'll end up wealthier in the long run, even though you're carrying debt longer. If your debt is moderate interest, that 5 to 7% range, do both. Maybe you split your extra cash 50-50 between extra debt payments and investing. Or you go 70-30 in favor of investing if you're aggressive, or 60-40 toward debt if you're conservative. The key is making progress on both fronts instead of being paralyzed by the decision. And if you're older, closer to retirement, or just psychologically uncomfortable with debt, it's perfectly fine to prioritize paying everything off, even if the math says investing would be slightly better. The peace of mind that comes with being debt-free is worth something, and you can't put a price on sleeping well at night. Personal finance is personal. The spreadsheet doesn't capture everything. What percentage of your income are you investing right now? If the answer is 0 because you're throwing everything at debt, you might be making a mistake. But if you're investing aggressively while carrying 25% interest credit card debt, you're definitely making a mistake. The answer lives somewhere in the rational middle. One more thing. This decision isn't permanent. You can adjust as you go. Maybe you focus on debt payoff for 2 years, then shift to aggressive investing for 3 years, then find a balance. Your income will change, interest rates will change, the market will change, and your strategy should evolve with these changes. Rigidity is the enemy of wealth building. The people who tell you there's one right answer for everyone are selling something, either a debt payoff program or an investment service. The truth is nuanced, complex, and depends on factors that are unique to you. Your interest rates, your risk tolerance, your time horizon, your income stability, your emotional relationship with debt. All of these matter. So here's your action plan. Calculate the interest rate on every debt you have. Write it down, look at it. Anything above 10%, attack it aggressively. Anything below 5%, make minimum payments and invest the difference. Everything in between, make a strategic decision based on your personal situation, and don't let anyone shame you for the choice you make. The goal isn't to be debt-free or to have the biggest investment portfolio. The goal is financial freedom, having enough wealth that you can make decisions based on what you want to do, not what you have to do. Sometimes that means carrying smart debt a little longer. Sometimes that means sacrificing growth for security, and often it means doing a little of both while adjusting along the way. What's your number one financial priority right now? Would you rather be completely debt-free or building a massive investment portfolio?